Good morning, everyone. Hello and welcome to yet another session in our series, Decipher with Dezerv. A quick introduction to some of you who are new to this series. In Decipher with Dezerv, we try and cover a detailed deep dive with industry or Dezerv experts into relevant macro policy or investment related topics, everything and anything that can influence your financial decisions and outcomes. Today's session is on Deserve's investment philosophy and approach. How do we as Deserve think of research about portfolio construction, and how do we monitor and take active oversight on your portfolios? To guide us through this, we are joined by Vaibhav Porwal, our co-founder and CIO. Vaibhav brings with him a combination of market intelligence and deep insight into investor behavior. He's been extremely instrumental in influencing the decisions of India's top wealth creators for over 20 years now. Welcome, Vaibhav.
Thank you, Hardik, and good morning to all our clients.
Alongside Vaibhav, we've got Pratik Bagaria. Pratik is our fund manager for our flagship equity revival strategy. He brings with him over 20 years of experience in the wealth management industry. He's been extremely instrumental in shaping our equity framework. Hi, Pratik.
Hi, Hardik. Morning to all the clients.
Hi. Let's get started. I think everyone is looking forward to an extremely insightful and transparent conversation. We'll start uh, with an introduction into Deserve. Weber, uh, while they've obviously, most of the clients have heard it multiple times, very quick introduction from you as one of the co-founders about who are we building for and what is the underlying investment thesis that guides our decisions day in, day out.
Thanks, Hardik. At Deserve, we are focusing on serving India's top wealth creators with our comprehensive wealth management offering. So currently, we are managing close to 14,000 crores of asset under management and also tracking assets of in excess of 1,30,000 crores through our flagship app called Wealth Monitor, where we are helping users analyze their portfolios and get real-time insights on that. All of this was possible because of backing of some of our clients who come from accomplished professional background. We have clients across top consulting firms, professionals, doctors, engineers, new age startup founders, and young professionals working with Google, Meesho, Amazon, Flipkart, and some of these companies. And we are also backed by institutional investors like Z47, Elevation, Excel Partners, and Premji Investments. What it allows us to do is to put in place a great foundation to manage investors' money, which is built on strong process, which is institutional grade, and at the same time allow us to be agile in the market. So as a combination of these two factors, process and agility, we have been able to create very useful investment products for our users across all the asset classes where we believe that investors should invest their money. So that's a bit about us, focused completely on India's top wealth creators and helping them grow their wealth and ensure that their money continues to deliver good returns.
Great. Vaibhav, do you want to walk through the suite of offerings that we've got here?
Yeah, absolutely. If you can move to the next slide.
Yeah.
Yeah. So as I was saying that it's a comprehensive wealth management solution that we offer, and we provide solutions across three different categories: equity, fixed income, and alternatives. Within equity, and most of our users are exposed to our flagship strategy, Deserve Equity Revival Strategy, which is a managed portfolio of basket of mutual funds. We have a similar strategy of a basket of mutual funds, which focuses purely on mid and small caps. Capital reserve is a strategy where investors transfer their securities and we manage them pending deployment in any of our other strategies. And recently, we launched our Category 3 AIF, which is first of its kind, investing in other AIFs, where we will be able to give exposure to the clients to some high quality boutique fund managers who are very good at picking up individual stocks. In debt, we have offerings across the spectrum. The flagship strategy there is Deserve Dynamic Debt Plus strategy, which we are managing for almost 2.5 years now. where we invest in a curated basket of bonds carefully selected by our PQRS framework. We also have smart tax balanced growth strategy, which is a multi-asset strategy where objective is to deliver high post-tax return while keeping fixed income risk in mind. Corporate surplus strategy focuses on managing short-term liquidity need of corporate treasuries and individual liquidity, which is available for a duration of 6 to 9 months. The last offering, again, first of its kind, is Deserve Credit Fund of Fund, which takes exposure to performing credit category, where target is to generate 13 to 14% returns by investing in a basket of other performing credit funds. Alternatives, we have been present across precious metal, venture capital investing, and private equity investing. So overall, we have covered the entire spectrum through various strategies. One common thread which is there for all these strategies is A, we have our proprietary model to evaluate all the opportunities, and these opportunities are presented to clients only after we have carefully evaluated and constructed our investment framework. And B, we invest our own money also in all of these strategies alongside clients.
Great, Vaibhav. Thank you for that brisk introduction into Deserve's investment thesis and the comprehensive suite of offerings. Reminder to everybody on the call, for today's session, we will actually deep dive into two of our flagship strategies. One on the equity side, which is equity revival strategy. The one on the debt side is Deserve Dynamic Debt Plus strategy. For any conversation with respect to any of the other strategies, you can reach out to your wealth manager. Be happy to take you through that. Moving on with our equity strategy. This is my favorite conversation with Pratik. Pratik, mental framework for all of us, lay investors is extremely clear. Go to any portal, look at 1 year, 3 year, 5 year performance history, select the ones appearing on the top and invest your money in those assets. So clearly, there is a bias that we should look at the securities where past performance has been great. That's a good enough proxy for future outperformance. One, is that the right approach? And two, if past performance is not a factor for evaluating future performance, what are the other factors that one should look at before deciding the securities that they invest in?
Yeah, so Hardik, I think this is one of the most common behavioral biases we see in the investors. Let me give you an analogy. There's a famous story about Mullah Nasruddin, who was once searching for his lost keys under the street light. When someone asked him if he lost them there, he said, "No, I'm searching. I lost them somewhere else, but I'm searching here because it's brighter here under the light." So investors also often behave the same way. They rely on the data that is easily available rather than data that's actually meaningful. So take smartphone users for example. Many people buy a phone just by comparing megapixels, right? Uh, but megapixels alone don't guarantee great photos. You also need to look at things like sensor size, aperture, image processing, and other things. So similarly, when it comes to mutual funds, returns are easy to see, but they are not enough. In fact, there is no consistent evidence that shows that yesterday's winners will remain tomorrow's winners also. So instead, we need to broaden our research and evaluate deeper into more reliable factors like how cheap or expensive is the fund's portfolio. So looking at the valuation of the fund, uh, is the growth sustainable? Uh, what are the macro conditions that we are currently witnessing and things like that.
Got it. Uh, Clearly, past performance cannot be relied upon. There are several other factors. We see here on the slide that there are almost 9 million data points that we evaluate before selecting securities, in this case, selecting mutual funds. Uh, just to make it comprehensible for a lay investor like me, can you sort of bucket what are these data points, right? What are we evaluating?
So we can bucket the data points into two buckets. One is your macro factors and one is the micro factors or fund specific factors. In the macro factors, we can look at two things. One is the economy, both global and domestic. By economic indicators, I mean things like your money supply, GDP, inflation, commodity prices, currency prices. Those will fall under the macroeconomic or economic factors. And market factors will be when you are looking at market as a overall index level. So what is the PE of the entire market, not a company in specific, but PE of the entire market, price to book of the entire market, the growth there. Let's say we have a lot of indices like growth index and value index. So what is the ratio between those two kind of index, growth and value? And then we come to micro factors where we are looking at fund specific indicators. So that could be related to composition of the fund, which tells you what is the size of the fund in relation to the market, how concentrated is the portfolio in the top 10 securities, how long is the tail, what are the number of stocks in the portfolio, how much it is invested in large cap, mid cap, small caps, those things. Second thing, you can look at the valuation of the portfolio. So let's say how the way you calculate the PE of Nifty. Nifty is nothing but a basket of stocks. The similar way you can calculate the PE of a mutual fund because it's also a basket of stocks. So if you calculate the valuation of like PE, PB of a mutual fund over a long period of time, you can notice some patterns, whether it's moving from growth style to value style, etc. And the thirdly, you look at the growth in those portfolios, whether the underlying companies are delivering growth.
Got it. So as a combination of macro and micro factors, you evaluate each of the funds, and then there is a potential outperformance that you predict, and basis that you are able to select the securities. Uh, uh, this is clear, Pratik. One other bias that us investors we live with is that once we've selected certain allocation within our equity basket, uh, what we call as buy and hold forever, unless there is a liquidity requirement, buy and forget. That's the thesis that we usually apply in our own investment approach, right? What would you say to that? Is this the right approach? Would you look at it differently? And if you would look at it differently, what are the parameters to consider when you actually are evaluating your portfolio at different points in time after you invested?
So if your objective is to generate alpha consistently, a buy and hold approach generally does not work because a buy and hold approach goes through a lot of cycles. In 2007, we are seeing that funds leaning towards value and infrastructure sort of companies, they were outperforming. Then around 2018, the funds leaning towards consumption and qualities kind of stocks, they were outperforming. And then you had 2020 COVID period, after which your value plus momentum kind of funds, they were outperforming. So, while the other set of funds was outperforming, the remaining were underperforming in a very big way. So if you buy and hold, you don't switch, you will miss out on the outperformance during those periods of 3 4 years. So for that reason, you need to keep on actively monitoring the markets and accordingly shifting your portfolio so that your alpha is consistent. How we do that in our portfolio is we have a method called cost benefit analysis. So before making any changes in the portfolio, we look at first what is the cost of that change. So basically, what is the exit load that we will be paying on the fund that we are exiting? What is the taxation? So are we paying short-term taxation of 20% or long-term taxation of 12.5%? Right? And then we see the opportunity cost. Had we kept the same fund for a longer time, we could have postponed the payment of taxes. So these three costs we look at, and we compare them with our analysis that what are we expecting on the fund. So if let's say my cost of shifting from the fund is 2%, but I'm not expecting that I'll generate 2% additional return by making this move, we will not make that move. But if let's say we are expecting to make a 3% 4% alpha with that change, we will go ahead and make that change. So it's a process, completely process driven approach that we follow to actively manage any portfolio.
And just to understand this clearly, the fund fact sheets are obviously available every month, so you are able to look at them and conduct this cost benefit analysis every month. But also, there are a lot of macro factors that keep changing. And
Right.
this comes to the point where you mentioned that our selection is a combination of macro and micro. So, and macro factors could be many, could be domestic, could be global. could be policy related, could be government decision related, could be political in nature.
Right.
In light of so many macro events, would you
Yeah.
consistently keep rebalancing the portfolio? Because as you mentioned, there's a cost to rebalancing the portfolio. How do you look at these events, and which are the events sort of which mandate any action on the portfolio at all?
So as Vaibhav highlighted in the earlier part of the call, that it's a combination of process and agility. So this is where the agility part comes in, where you are looking at the constant news flow, and if it is material enough, it is impacting your portfolio or is expected to have a material change, you make those changes. If we take 2024 for example, out of the 12 months, we had changes in 3 of the months. So in April, when the GDP forecasts were raised, the sentiments were positive. Uh, we made the portfolio a bit mid cap heavy. We went in aggressive. In June, or let's say October, when the mid caps were expensive and FI outflows were there, there was this Hyundai IPO and a lot of supply coming in. We reduced our exposure, started trimming our exposure from mid cap and small cap. So those are the 2 3 times we have taken action. But say other things which were not having a very long lasting impact. For example, in August there was a big UN cry about this yen carry trade unwinding. It came and it went within a week. So those are the kind of news flows where we do not react.
Got it. And while these are the major events which sort of mandated any action on the portfolio, can you sort of run us through some of the actions that you would have taken over the past 3 years of managing ERS? And what changes did you make, and what sort of outcomes did we gain out of these changes?
So, as I was just saying that in October 24, we made a lot of changes, but I'll just run you through a couple of them. In October 24, the valuations of mid cap, small cap, and generally the market were very rich. And we decided that we want to start trimming the mid cap exposure. We cut that down in October itself by 5%, and increased the exposure to large caps. And from then, we have seen that large have performed better than mid and small. Similarly, let's say in April 24, we we uh, we did not have any dedicated small cap funds in our portfolio. We said that if we want to take small cap exposure, we will do it through mid cap funds, because there was some concerns around liquidity and other things. So we constructed an aggressive portfolio, but without any dedicated small cap funds. And the selection of the funds turned out to be in our favor, and we ended up picking 2 or 3 of the best funds in the category during that period of time. If I were to go a little back in, say, let's say May 23, uh, uh, we entered the small cap fund, and uh, increased the allocation in 23 to small cap funds, when basically the valuations were looking cheaper. So from May 23 to 24 is, or 20 October 24 is when you can say we had a larger exposure towards small and mid, but after that we started cutting it down.
So broadly, within 18 months, the portfolio
Correct.
construct shifted significantly towards larger cap funds. Great. So, summarizing the key takeaways for me over here, one, past performance, perhaps, this we should print it, have it as our banner, that past performance is not an indicator. We need to evaluate many more factors before we end up selecting securities for our equity portfolio. uh, uh, as you mentioned, it's a combination of macro and micro factors, but there are like over 2000 schemes that we evaluate on a regular basis to be able to come up with a portfolio construct of 6 to 8 funds. Second, buy and hold forever does not allow you to consistently outperform the market, which is why you need to actively rebalance the portfolio, again in light of any macro or key macro changes that could potentially impact your portfolio performance. You need to make changes. What changes need to be made? Again, come back to the same process that we follow of evaluating the entire universe of schemes and then coming up with potential outperformers over there. And what stays with me honestly is what Webo mentioned earlier and what you mentioned right now, just process and agility. Follow a process of selection, but also be agile enough to amend to the changes in the macro or microstructure of the funds. Uh, Thank you, Pratik, for taking us through, a
Thank
very
you.
insightful walkthrough of our equity revival strategy. I understand this is quite a rigorous process to be able to come up with portfolio construct every now and then, and actually to manage so many portfolios at the same time. We'll move on to our flagship debt strategy. Vaibhav, this is a classic question for you. For a lay investor like me, again, I would look at the rating rationale, look at where the rating is. Triple A is the lowest risk, A is the higher risk, and then accordingly choose securities for my debt portfolio. One, again, is this the right approach? If this is not the right approach, what are the other factors that could determine the performance in a debt portfolio, and how do we conduct our research here?
Oh, thanks, Hardik. So just to conclude on ERS, there is a mutual fund disclaimer which always comes. Past performance is not indicative of future performance, and that one single disclaimer all of us forget about every time. Amphi itself has guided us that past performance is not indicative future performance. So let's be mindful of that. For fixed income, so there is a maxim that we strongly believe in. In God we trust, and everyone else should bring data. So in rating, we don't trust completely. So rating along with data is what we trust in. So what we have been able to do is to put together a framework to build fixed income portfolio. But before I get into the framework, it's important that we establish why we created this framework. See, typically, most of the investors will rely only on ratings. Either they will say that AAA is good for me, or they're chasing returns by compromising on the ratings. So the sole criteria, or two criteria that most of the investors follow, is either high yield or rating. And both of these don't work in isolation. So for example, most of the large defaults which have happened over last 7, 8 years have happened in AAA category. So which obviously doesn't insulate AAA category from any kind of default risk. And unfortunately, in fixed income, when you lose capital, you lose the entire capital. Don't just lose returns. So it's important that you don't rely purely on rating. It's a lag indicator. It's not a lead indicator. So it's like once you participate in the race, only after the race is over, you'll get to know who came first. So that's how the ratings work. And when in terms of returns, you are looking at high yielding, it's important that you look at other parameters also to make sure that you are not taking disproportionately large risk. So our thought process is we want to create a portfolio which generates returns which are higher than fixed deposits. At the same time, we don't want to compromise on the quality of the portfolio. So we developed our proprietary framework called PQRS framework, which is a credit scoring framework across 4 broad parameters. So these parameters are performance of the company, qualitative factors around management and governance, rating action, which obviously is one part of it, and solvency ratio, which guides about the ability of the firm to repay your debt. So in performance, we look at business performance, business efficiency, ROE data, cost of borrowing, net interest margin that the company is generating, and some other factors like geographical diversification and others. Qualitative factors again are extremely important for us. For example, when we are evaluating any NBFC, we look at the composition of the board, how many directors are there who are independent directors, and their history or their credentials. Also look at quality of promoter, quality of shareholders. One parameter which is extremely important is continuity of existing lenders to lend money to the organization. That for me is a lead indicator. Your primary lender, the moment they start reducing the amount of money they lend to the company, that for us is a great indicator that there is some risk building up in the business. Other factor which again becomes really important is related party transaction. A lot of these companies which have defaulted in the past were entering into related party transaction well ahead of their default. So we analyze that also. Ratings are important, but who rates the company is also equally important. So credit rating agency and the recent credit rating actions become part of our rating evaluation. Last but not the least is cash flow assessment of the company. Company might be making profits, but if there are no cash flows to support repayment, then repayment is always dependent on the refinancing of loan. So asset liability mismatch, which means the kind of maturities that company will see in terms of liquidity and kind of liabilities which are due over next 18 to 24 months are deeply analyzed to arrive at surplus of liquidity in the balance sheet. If surplus is there, then we lend money. If there is no surplus, then we don't lend money. All of these factors have to score individually and as a composite score. If even if the company is not scoring on one of these parameters, we choose not to invest. And as I said, rating is a lag indicator. You would be surprised to know that 60% of the portfolio that we invested in over last 2.5 years has seen rating upgrades after us investing in these papers. So that's the strength of this framework where we are able to analyze these balance sheets, businesses ahead of the curve and invest and take advantage of higher yield that they are offering. At the same time, making sure that we don't take any risk in investing.
Fair point, Vaibhav. This seems to be an extremely comprehensive way of looking at issuers in the market and then constructing our portfolio on the debt side. I actually go back, to your maxim of process with agility. How do we follow that here? One is this process while selection of securities. Within debt, do we follow agility in any manner?
Yeah,
Even in terms
absolutely.
of
Agility comes, there's obviously we spoke about 60% of our portfolio has seen rating upgrade. So agility comes at three levels. First, reinvestment of capital in an efficient manner. So every time there is a payout from the bond, whether it is coupon or part principal repayment, we make sure that money gets invested without any delay. So you continue to enjoy compounding in the portfolio. Second, anytime there is a maturity of the bond, money gets auto reinvested in new bond. So you don't have to worry about reinvestment of that capital. Third, in case we see any risk emerging in the portfolio, ahead of the curve, we are able to exit out of these securities to make sure that the risk is taken care of. Uh, so all of these factors add to agility, which is there, and it is supported by a robust process where we are constantly monitoring all the data points and are able to take decision on these investments.
Got it. Thank you so much for the deep dive into our flagship debt strategy. We've obviously covered both our equity and debt strategy in this session. As I mentioned earlier, while we've got a comprehensive suite of offerings, to reach out to your wealth manager in case you want a deeper dive into any of the other products. We'll obviously try and cover some of the other products in subsequent sessions. Uh, what I like to cover right now is a quick run through of performance of each of these strategies. If we can move on to the next slide. Uh, ERS, of course, since inception, we've been able to outperform the BSE 500 TRI, which is the benchmark that we've chosen for this strategy. On a 3-year basis, almost 3% plus outperformance. Uh, as we mentioned, the idea is to consistently outperform the index. Uh, However, given that this is a long-term product or long-term allocation as part of your portfolio, obviously the indication is on the right-hand side, which is 2 year, 3 year, is what is more relevant from an investor perspective. Weber, on this slide, I'll actually like to spend a couple of minutes and let the audience understand what does the table on the top indicate. What is this up capture, down capture? If you can explain the investors here on the call.
Sure. So to consistently generate alpha, you need to create a portfolio which is able to capture markets upside, but on the downside, it protects your capital. So up capture ratio tells you what is the correlation between your portfolio performance and market performance. So when we see the number 97.8, that means if markets go up by 10%, this portfolio will go up by 9.78%. So very similar to what markets would do when markets go up. There is a monthly data. So every month over last 36 months, when markets went up, we went up equal to 9.78% on an average. Months in which markets went down, our portfolio fell much lesser than the market. So 75.2% down capture means when markets went down by 10%, our portfolio would go down only by 7.5%. So what it does is you're always recovering from a higher base, and which delivers this alpha. Why it is important is because this gives us ability to stay invested in the portfolio for a long period of time without being over worried about volatility that the portfolio can generate. It is an integral part of our process where we are saying that we'll curtail the downside, maintain the upside, and as a combination of these two factors, we'll be able to generate an alpha for our investors.
Great. This is on ERS. Moving on to the next part, which is on triple D plus strategy here. As some of you would be aware, this is a portfolio that comprises of certain corporate bonds, REITs and InvITs. You can see that we've consistently been able to outperform the benchmark. Here, the available benchmark is CRISIL Composite Bond Fund Index. Idea is to keep managing risk on a timely basis and obviously take any advantage of potential rating upgrade that could happen in the underlying portfolio. With this, I'd pause here. We've covered the walkthrough of our core strategies in this session. Obviously, the underlying investment thesis that guides our selection as well as our active oversight day in, day out. I'd like to move on to Q&A from here, Vaibhav. There are a series of questions that have come up on the Q&A tab. Anybody else who wishes to post questions, there is a Q&A tab on the bottom right. You can post your questions. We'll try and cover most of the questions. We'll try and sequence it in a logical flow so that it's meaningful and productive for everybody on the call. With that, I'll start with the first set of questions. Pratik, this is a question for you. What is the portfolio turnover rate in ERS strategy?
So we try to keep the portfolio turnover under 25%. So let's say on an average, the holding period of a fund is around 3 to 4 years. And that's true for most of the clients that we are having.
Got it. So portfolio turnover less than 25%.
25%, correct.
Okay. And this brings us to our next question, which is how tax efficient is ERS?
So as I discussed in the rebalancing logic, how we decide to change the portfolio, we do not sell anything unless and until there is a merit to sell it in short-term capital gains or with exit load. So rarely you will see that we have sold something under exit load or under short-term capital gain tax. So most of it you will see that your sales have happened under the long-term capital gains, and after a completion of 2 years or 3 years of the fund. So it's fairly tax efficient in that sense.
Got it. I'd like to cover one more question on ERS. Pratik, the comparison of returns between BSE 500 and Dezerv ERS looks good, but is it after cost and expenses?
Yes, it is after
It's after
cost and
cost. Will ERS have small cap funds too, or is it dedicated only to alpha strategy?
we will have at least 50% large cap is the internal guideline. We can change that, but as of now we have decided we will have 50% large cap, but the remaining 50% we can go into small and mid caps. So that is the aggressive part of the portfolio.
How would this differentiate from a flexi cap fund?
So flexi cap funds do not have a hard limit of large cap or mid cap. They can go up to 100%, because let's say if some flexi cap fund grows really large, they can comfortably sit in 90% large caps and there will be no questions asked, right? They do not have to have small and mid caps. So in our case, that's the difference.
Got it. Are we covering alpha and other PMS strategy? Sorry, I joined it. Sorry, we'll be covering this subsequently, or you can reach out to your wealth manager to arrange a walkthrough for you on those strategies. What is the ideal number of funds that one will have in the ERS portfolio?
That should be between, if it's a new portfolio, around seven. An old portfolio will have some legacy funds, so around 10 to 12. But it should be under 10 in most cases.
Got it. Why is portion of my money kept in cash for some period rather than being invested immediately?
It is unlikely because the day we receive the money, we deploy it in
No, I
the
think
funds.
cash, I think they mean liquid or arbitrage.
Okay, so the 0.5% of the portfolio is invested in liquid funds. That is because that money covers up for the running expenses of the fund.
Okay. Uh, got it. Is there any way to expedite the alignment of my portfolio to the modern portfolio, assuming it's not rebalanced due to cost?
Yeah, so by September end, you will see most of the portfolios aligned to the model portfolio. Also, it is important that the benchmark should not be alignment towards the model portfolio, but your portfolio should be uh, uh, decently poised to generate alpha of over BSC 500. That should be the benchmark. Because if you try to align completely to the model portfolio, you might end up incurring costs which are not getting factored in the model portfolio construct as well.
Pratik, one easy way would be just to bring in more cash uh,
Yeah,
to sort of align it to the model.
yeah, that will be great.
Got it. At what frequency should I evaluate my performance in ERS? Whether you want to cover that both in terms of portfolio review as well as at what frequency should they be looking at their portfolios?
So the way portfolio is designed is it's likely to deliver outperformance over 2 to 3 years holding period. So broadly, if you are looking at your portfolio at quarterly intervals and see the trajectory, that is good enough. But in a short period of time, you might see underperformance or outperformance. But as you keep expanding your holding period, there is a great probability that you will see outperformance in the portfolio. So 2 to 3 years is a good period for you to
Got it.
consider.
Pratik, next question is for you. Is this research conducted on a finite set of mutual funds? Do we exclude any mutual funds from our research?
We exclude ELSs, equity linked saving schemes. We do not, while we research sectoral funds, we will not include them as of now in the ERS portfolio, and some of the thematic funds, which play a very concentrated theme like Digital India or EVs.
Got it. And anyway, basis our selection or our framework that we've created, basis vintage or AUM size, some of them will naturally get excluded, right?
We try not to do that based on vintage. For example, you have a lot of fund houses which have been running their PMS for a long time. So they have a vintage, but in the mutual fund industry, they might not. So we try not to exclude those kind of fund houses. We try to take everything into account.
Got it. So it's quite a kind of comprehensive.
Yes.
Got it. Weber for a, okay, actually, let me cover equity before I move to debt. Uh, Similar question, Pratik. I saw model portfolio was updated, but why was my personal portfolio not rebalanced at the same time? I think you've covered it. It goes back to the cost benefit analysis that we do
Yeah.
and make it custom for your portfolio rather than changing everyone's portfolio at the same time. Okay, how about my follow-on SIP investments being invested? Does that get allocated to a single fund or it's distributed across all funds?
So it gets invested in first in the fund with the best outlook, and I'm assuming you already have a portfolio, and then on top of that you are doing SIP. So first it will get allocated to the fund with the best outlook, and the remaining SIPs in that order.
Okay, got it. Would like to cover a couple of macro questions and what do we foresee basis that. One is, of course, the additional tariffs that have been on India, imposed on India by the US. Do you see any amendments to the portfolio based on that?
Yeah, so we have already started making amendments in the portfolio, and most of the portfolios will start transitioning towards more domestic economy driven industries, and we are investing in funds which has higher exposure to these sectors. So that's the shift that we will start to see in the portfolio. This transition we started about 6 months ago, where we started increasing our allocation to banking and financial services, and we continue to move towards that direction with the inclusion of consumption, consumer discretionary, and consumer staple plays also in the portfolio.
Vaibhav, several questions on alpha focus strategy. You want to briefly cover to spend 2 minutes on alpha focus and whether that warrants an allocation in investors' portfolio now?
See, Alpha Focus is primarily investing in mid and small cap category, and in mid and small cap, our view for last 12 to 15 months has been that valuations were expensive. So now we are seeing some resetting of valuation happening, especially in case of mid cap category. So mid cap index has seen a decent amount of earning growth, whereas small cap index has seen negative earning growth. So we have made certain changes in the portfolio, and it's a good time to start allocating part of your capital to Alpha Focus also.
Got it. Uh,
But one thing, Alpha Focus will always be more volatile compared to ERS. Come in with a slightly longer term investment horizon.
got it. All right. I think moving on to some of the other strategies that we have. Weber, what tenor would you recommend for someone to invest in triple D plus? Is this comparable to a short duration liquid or debt scheme, or should somebody look at a moderate or longer term period while investing in triple D?
Anyone who is comfortable with the holding period of 9 months and above should invest in triple D plus comfortably.
Got it. Couple of questions around that. There is a TDS deducted on their income, but they've obviously not received any payout. Can you explain how this works so that they are clear in terms of this money getting reinvested and increasing the value rather than being paid out?
So what is happening here is whenever there is any interest payout, TDS is deducted in the name of the investors because securities are held under investors' name. But all the payouts are received by the PMS scheme of that specific client. And we ensure that money keeps getting reinvested efficiently so that there is no leakage of returns. So if investors wish to pull out money or if they need some cash flow, they can request their wealth manager to give a payout from the scheme itself. Our idea is to ensure that there is no inefficiency in the process and money doesn't remain idle in the portfolio.
Got it. Weber, how do you see REITs and WITs both in terms of availability of supply and portion of allocation within triple D plus or generally as part of the overall fixed income allocation of a client's portfolio?
So in triple D plus, we have maintained allocation of 10 to 15% to REIT and InvIT, and we continuously look at all the new issuances which are coming and ensure that portfolio gets allocation to these REITs and InvITs. Again, we run our own evaluation and basis that we select the REITs and InvITs in which we want to participate. This asset class is interesting, and over time, investors should have 10 to 15% of their portfolio in this asset class because this will give investors a recurring cash flow plus potential capital gain upside also.
Got it. Couple of questions on tax. Again, going back to ERS, fresh questions. Would like to remind everyone that the taxation for mutual fund strategies is similar to you directly investing in them versus investing via Dezerv. So there is no change in terms of the post-tax return that you would generate directly investing or investing via Dezerv. Weber, taxation on bonds.
So taxation of bonds is applied at two levels. On interest income, you would be paying marginal rate of tax. So whatever is your applicable marginal rate of tax, that will apply. Sometimes there is a capital gain on bonds. On listed bonds, if you hold for a period of more than 1 year and there is a capital gain, that attracts 12.5% rate of tax, which is capital long-term capital gain rate of tax on that. On REIT and InvIT, again, you get STCG and LTCG on price movement. And income, which is distributed, could be a combination of dividend, which is exempt from tax, or interest income, which gets taxed at marginal rate of tax.
This is actually an interesting question. Uh, Given you have a view on both debt and equity, can you not dynamically manage my portfolio and decide to change allocation of equity into debt, looking at the market, or vice versa?
So we are working on a strategy where we'll be managing asset allocation dynamically, and soon enough, we will be able to participate in that.
Great. View on global investments, USD or China or any other geography that you are looking at?
See, unfortunately, the universe which is available in India to invest in some of these is limited, so which creates a limitation for us to participate. But standalone, I think it's a good idea to diversify your allocation, and we will try to create some solution around it.
Or is the tax liability similar for FD vis-a-vis triple D? Briefly covered that, but
Yeah, mostly triple D will be slightly lower because of some component of capital gain.
capital. All right. Portfolio turnover rate and flagship debt strategy.
Portfolio turnover rate actually is very low in flagship debt strategy. We generally hold all of these bonds till maturity. So there is no turnover. The only turnover which happens is whenever the bond matures, we reinvest that money into a new bond. So in general, the turnover is very low.
All right. Uh, I think currency hedge strategy did not find a mention in the PPT. Why so? I want to take that up and talk
It's
about
there.
Shine.
Precious metal is there.
We've just renamed it to Shine.
Yeah.
So the strategy is the same. We've just renamed it. Typically, how many bonds in a triple D strategy?
6 to 7 when we start the portfolio. When we reinvest the money, the number can go up to 8 to 9.
Actually, three different questions, Vaibhav, around timing of investment. One, how are lump sum investments taken care of? Are they immediately deployed? Two, I'm currently doing an STP. Can we consider moving the funds altogether given the current market scenario? And three, what about SIPs that I'm investing? You want to cover broadly around deployment?
Okay, so if you have lump sum, we are guiding investment across 4 installments, 25% upfront, and then 25% over the next 3 months in a monthly or a fortnightly installment. SIP you should continue because that largely depends on the cash flow uh, that you're receiving. So you should continue to invest in SIP based on your cash flow, cash inflows.
Pratik, any large cap allocation at all in Alpha Focus?
No, it is a strictly mid and small cap strategy only. No large cap allocation there.
If it is there, it is incidental if some funds are holding some large cap position.
Yeah.
We don't intend to invest in any large cap fund.
Got it. Difference is 3% after tax deduction. Will it be lower? Actually, no, the tax is the same if you had invested directly, as I mentioned, versus if you invest via Dezerv PMS. Uh, Perspective on recent GST reform. We obviously covered tariffs. We've not covered GST reforms. Vaibhav, any view?
So we recently released a note on that. It's a great along with series of positive announcement that the government has made, including tax rate cut for individual taxpayers to interest rate cut to GST cut to implementation of 8 pay commission. All of these are positive announcements which have come from government, and this should address the demand side part of the economy. So consumption should go up as a result of that and should give confidence to consumers when they spend money.
Is the portfolio in triple D secured? If yes, what is the collateral coverage percent?
So all the securities in which we are investing are secured, and we don't invest in any unsecured paper. Uh, we ensure that balance sheet coverage is there in most of these cases.
Right. Standalone view on gold and silver at this point in time.
So we continue to like them, and we have increased allocation to silver in our precious metal strategy. And now today we have equal allocation to gold and silver both.
Uh, what is the impact that you see with Geo BlackRock?
Right. So I think last session also I had this question. It's a positive development. We'll have more product offerings. And for our investors also, if we are able to find new investment opportunities, we will bring them into Dezerv strategies.
Related question, Weber, what is your view on SIFs?
Again, extremely positive positive view on SIFs. This will give greater flexibility to mutual fund managers to manage money, and that in turn will help us create strategies around that.
Do we hold direct funds in our demat? The answer is yes. This is a question for you, Pratik. What is your take on index investing? I feel most times index investing beats the active investment, is the view that the investor has. Any feedback from you?
So our view is that we don't want to stick to any particular style, either active or passive, right? We can look at both of them objectively, and there will be times when active does well, which is for example last from 2020 to 2022-23, you had seen that actively managed funds did much better than passively managed funds, and there will be time when passives outdo the actively managed funds. So instead of our philosophy is that instead of sticking to any one of them, you would opportunistically switch between them and make best of both.
Yeah, I think one additional point that is important to note is that index investing is not about generating returns equal to the index. There is a cost associated with that. So if you invest in large cap indices, the cost would be between 30 to 40 basis per annum. So returns will always be index minus 30 to 40 basis. In case you are investing in mid and small cap indices, the cost could be as high as 1% because of higher tracking error and higher cost of management. So index investing should not be seen as something which will always give you index like returns. So there is a cost and you have to factor in that cost.
One more addition actually. So unlike earlier where you had index fund, the only choice was Nifty 50 index, right? You have so many indexes right now. What would you call index investing? You have momentum, value, etc. to pick. How do you make those choices, and what would you call index investing? Well, even index investors will have a very divergent returns.
Got it. Pratik, then a follow-up question to that. Do we include momentum funds in the fund universe?
Yes, we do have momentum funds and all the passive funds in our coverage. Uh, if they pop up in our research, we might see them in our model portfolio also. In fact, towards the start of the strategy, we had NV20 in our portfolio.
How is watermark value calculated when someone does SIP returns? Weber, you want to briefly talk about watermark and scenarios like SIP? How do we cover for that?
Sure. So let's say you invest 50 lakh rupees and value after 1 year becomes 60 lakhs, and we charge a fee on 60 lakhs, and then you continue to add SIPs on a monthly basis of 1 lakh each. So your watermark will keep changing upwards from 60 lakhs plus 1 lakh, 61 lakhs, 61 lakhs plus 1 lakh, 62 lakhs, and so on. So every time there is a capital infusion that gets added to your high watermark which was set at the point of previous fee charge.
Got it. Can someone invest their portfolio in both ERS and alpha focus? Sure, the
Yes.
answer is yes. Allocation would differ basis risk appetite and your overall portfolio. Um, I'll try and cover a couple of questions before we wind up for the day. Sorry, we've been overwhelmed with the number of questions. There are 100 plus questions. For any question that we could not answer on this session, I would request you to reach out to your wealth manager. Would be happy to assist you outside of this session as well. Classic question, Vaibhav. Lot of questions on the same lines. How are we using AI to power our research? Do we see AI's impact on our selection process, so on and so forth? Sort of touch upon that.
So we use a branch of artificial intelligence called machine learning algorithm to analyze data. Because the amount of data that we are analyzing is so large, it's very difficult to do it without the help of these tools. So that's where a big use of AI is there for us.
Got
And
it. So anyway, as part of the
we
selection
are
process.
constantly looking at newer models which are using AIs. In case we are able to extract better efficiency or better selection model, then we'll continue to incorporate that in our investment model.
In the funds that I have transferred to Dezerv, I see funds which are at profit also being sold or funds in loss being held. What is the logic? How are we managing these transferred assets?
See, Pratik covered it, but we don't look at historical performance. We look at future performance, and even if the fund is in profits, if the outlook is not great, then we would rather sell that. And if the fund is in losses, and those losses could be because of the timing of investment also, and if we believe that the outlook is fair, we'll continue to hold them.
Fair. So it depends on the outlook, not really on historical performance of the fund. Question with respect to repatriation and taxation as an NRI. I think your wealth manager can handle that question. If not, do reach out to us. We'll be happy to assist you. Uh, does selling of mutual fund also get the benefit of 1.25 lakh capital gain?
Yeah.
Yeah. Would you rather transfer to equity from triple D plus over time, or should we keep the money in liquid and arbitrage as part of the strategy and then allocate to equity?
I think since the guided time horizon is about 3 months to deploy money in equity, it's better to keep it in liquid and arbitrage.
Perfect. I'll take one last question and then we wind up for the day. Does ERS include multi-asset? No, it's equity only. What is the benchmark for alpha focus? Pratik, is it different from ERS?
The SEBI has defined certain benchmarks to be used for PMS strategies, and we have to select one of these benchmarks only. So, for all practical purposes, it's a mid and small cap strategy, but for reporting purposes, we need to use BSE 500.
Perfect. I think with that, we'll, as I mentioned earlier, we'll try and cover rest of the questions one-to-one with your wealth manager. You can reach out to us. We'll be happy to assist you in any of your other queries. We hope today's session gave you deeper insights in terms of how we are thinking of our investment philosophy and what are the principles that guide our investment decisions day in, day out. As we've repeatedly mentioned, we are committed to this partnership with the clients, and conversations like today only strengthen the partnership with you all. This was very interactive. We are kind of overwhelmed with the kind of questions and the amount of questions that we've received. Thank you so much for spending Saturday morning with us on this session. Until next time, take care. Feel free to reach out to us. Have a great day. Thank you so much, Vaibhav and Pratik.
Thanks.
Thanks, everyone.